Gonna try and wind up this topic in one last video where we're going to talk about estimating liabilities. There are instances where we know we're going to have a liability. We're just not sure how much it is. So we still need to make entries to record liabilities in an amount that we can reasonably estimate. In this example, we know that we're going to pay a fixed amount for health insurance, but we're going to contribute an additional 10% of an employee's salary, and in this case, $120,000 to a pension program, so we can reasonably estimate those costs and record those liabilities. Vacation is something that we similarly have to track. If we owe vacation time and we're not taking a liability for that, it's not, our books are not properly going to reflect the fact that we have this liability to our employees. So we're going to claim a vacation benefit expense. And this is done every pay period. So if you work for an employer that records, I don't know, I'm just pulling, 4 hours per pay period, then the employer is going to have to quantify at an hourly rate how much that 4 hours is for every employee and then do the top journal entry. Then when the employee actually takes the vacation, it's going to be the vacation benefits payable gets reduced and then it gets paid out in there will still be taxes that come from that. But this is a really rudimentary example of how we're going to record that liability of vacation time that's owed to those people. If they leave the company and that money is cashed out, we absolutely need to ensure that we keep track of how much that is. Here is a way in which we would record a bonus that we're going to be paying to employees. So this is going to be a shared bonus, not for one particular employee. We'll somehow come up with a way to allocate it, but we still want to record the fact that we are obligated to pay $10,000 to one or more employees, and we have an expense. Where this starts to get really messy is when it comes to things like warranty liabilities. If we sell a product and we know that a certain percentage of products get returned to us for service, and we know roughly what the labor and the materials cost is for that warranty work, we really need to account for that at the time the sale happens, because we know we're going to have the expense, and we want to make the expense for that warranty match the time period in which we had the revenue from that sale. It's sort of back to that matching principle. So we need to estimate how much we think we're going to have for warranty expenses, and then we're going to take that as an estimate. So we've got here December 1, we estimate. Now often this is done based on a percentage of sales. So if we know that 2% of our product gets returned for warranty work, then right off the bat, we're going to just take a warranty expense for that, in my example, 2%. And then we will have an estimated warranty liability of $640. Now, when the person brings the item in to actually have the warranty work done, we're then going to reduce the liability because now we've fulfilled some of that obligation. And remember, this is just a catch-all. We're not doing this per customer. This is just an overarching estimate that we're making. So anytime any customer brings in an item for warranty work, then we debit that warranty liability account to show that we've partially chipped away at that, and then our credit will go to auto parts inventory. We could also have labor in addition. So, and I don't know why this pops up second, but anyway, this indicates an average 4% in this company's estimation of what they're going to have for warranty expenses. And now we're going to sort of wind this up with contingent liabilities and a little ratio discussion. So a contingent liability is something that we suspect may happen. And depending on how strong we suspect that happens, depends on how that item gets recorded. So or I should say that event. So if we determine, and there are three categories, the event could be probable, possible, or remote. So if the future event is probable and we can reasonably estimate the amount, we're going to record an estimated liability for that. On the other hand, if the future event is probable and we're not sure how much to record, then we just disclose it in the notes to our financial statement. If we don't think it's probable, but we think it's possible, then we're going to disclose it in the notes to the financial statement. If we think that the chances that we're going to have to pay out on this are remote, then we don't disclose it at all. This comes up quite often in lawsuit situations where the company's being sued, the financial statement period rolls around, and we have to tell our shareholders something about this lawsuit. So we go to our attorneys and we say, okay, what are the odds we're going to have to pay out on this? And the attorney will say, it's not looking so good for you. I think you're probably going to have to pay. We say to the attorney, what's this? What do we think we're going to have to pay? And then if the attorney can quantify that and give us an amount, we will then record that estimate. If the attorney says, I'm not really sure in this instance, I really can't say, then it just goes into the notes. And so, as I said, this is most often going to arise when we have potential legal claims. It could also show up if we have guaranteed a debt on behalf of another entity. There are instances where somebody can go get a guarantor that will help support their creditworthiness for an obligation. And so if we think that there is some possibility that they will default, we go back to these three odds, I'll say, and decide whether it's probable, possible, or remote, and then that's how we decide whether or not we record an obligation for that potential default. There are other liabilities that could occur. Environmental, there could be, damages, or there, we could know, okay, well, we're being audited and we think we're going to owe more in taxes if the government gets a really good look at our books. So perhaps we should disclose that we may have a liability coming. Then there are uncertainties that are not contingencies, and those are future events. So we don't want to disclose something in our financial statements that didn't occur in some way or cannot be in some way tied to the financial statement period. So if we our financial statement period closes December 31st and we have a some sort of downturn in our operations, maybe a weather-related event or something like that, and we don't know what that might mean for us, or maybe there's an economic downturn in the market. If it's not related to a past transaction, we're not going to disclose that. And we're going to wind up this lesson with some ratio discussion. One of the most common ratios that's utilized by lenders is what's known as the times interest earned, or also known as the debt coverage ratio. And what this ratio tells our creditors is how well we are going to be able to meet our obligations for, at least if nothing else, the interest expense on any money they loan to us. Even if we can't pay the principal amount, are we at least going to be able to cover the interest as time goes on? And because that's kind of, if we can't even cover the interest on the amount that we're borrowing, probably not going to be able to cover the principal either. So that calculation is income before interest expense and income tax expense, and that's divided by the interest expense. And this is certainly going to vary from year to year because our income's going to vary, and as will our interest obligations. So this will help our lenders understand what our position is in terms of the risk that they're going to assume for us. In this example, we've got $150 in net income over $60 of interest expense. And I should say net income before interest and taxes. So we've got the interest expense. Our net income is the bottom line, but we want to go above that and look at income before interest and taxes, and then divide that by the interest expense. And we have in income 2.5 times the ability to cover our interest expense. So that's at least good. If we're less than 1, we're in big trouble. So I'm going to stop this here, and you're free to look through the appendix for various payroll reports and detailed procedures, but those really go beyond the scope of today's lesson.